The Intelligent Investor is a renowned investment book written by Benjamin Graham, widely regarded as the father of value investing. Originally published in 1949, the book offers timeless principles and insights for successful long-term investing. The main objective of the book is to guide investors towards a rational and disciplined approach, emphasizing the importance of thorough analysis and risk management. Chapter 1: Investment versus Speculation. Chapter 1 of The Intelligent Investor lays the foundation for the book by distinguishing between investment and speculation. Benjamin Graham emphasizes the importance of adopting an intelligent and rational approach to investing rather than engaging in speculative activities. Graham begins by defining an investment as an operation that provides safety of principal and an adequate return. He believes that investing should be approached with a defensive mindset, focusing on preserving capital and minimizing the risk of loss. In contrast, speculation involves making risky bets on the price movements of stocks or other assets, driven by hopes of quick profits. The chapter highlights the pitfalls of speculation, emphasizing the speculative nature of the stock market. Graham introduces the concept of Mr. Market, an imaginary character representing the stock market's behavior. Mr. Market is depicted as a moody and irrational individual, offering investors opportunities to buy or sell stocks at varying prices based on his emotions. Graham advises investors to take advantage of Mr. Market's irrational behavior by being patient and opportunistic. Instead of being swayed by the market's daily fluctuations, investors should focus on analyzing the underlying value of a company and its stock. By seeking undervalued stocks and selling overvalued ones, investors can capitalize on the market's mispricing and potentially earn higher returns. The chapter also emphasizes the importance of thorough analysis and research in making investment decisions. Graham advocates for a quantitative and qualitative assessment of a company's financial statements, earnings history, competitive position, and management quality. By conducting diligent analysis, investors can estimate the intrinsic value of a stock and determine whether it offers a margin of safety. Furthermore, Graham warns against the dangers of market speculation and the influence of crowd psychology. He encourages investors to resist the temptation to engage in speculative activities driven by market hype or short-term trends. Instead, he promotes a disciplined and patient approach to investing, focusing on the long-term outlook and fundamental value of the investments. In summary, Chapter 1 of The Intelligent Investor establishes the distinction between investment and speculation. It highlights the importance of adopting a defensive and rational approach to investing, being aware of the speculative nature of the stock market, and utilizing the opportunities presented by Mr. Market's irrational behavior. The chapter sets the tone for the rest of the book, emphasizing the principles of value investing, thorough analysis, and disciplined decision-making. Chapter 2: The Investor and Inflation. Chapter 2 of The Intelligent Investor explores the impact of inflation on investment returns and provides insights on how investors can navigate this economic phenomenon. Benjamin Graham begins by defining inflation as the persistent increase in the general price level of goods and services over time. He acknowledges that inflation erodes the purchasing power of money, and therefore, it is a crucial factor for investors to consider in their investment strategies. Graham argues that inflation poses a significant risk to fixed income investments, such as bonds and cash equivalents, as their returns may not keep pace with rising prices. He cautions investors against relying solely on fixed income investments during inflationary periods and advises them to seek alternative strategies that can provide protection and potential growth. One strategy Graham suggests is investing in stocks. He explains that stocks, particularly those of well-established and financially strong companies, have the potential to deliver higher returns than inflation. Additionally, he advises investors to focus on companies with pricing power, as they are more likely to pass on increased costs to consumers and maintain their profitability in inflationary environments. Furthermore, Graham introduces the concept of defensive investing during inflationary periods. He recommends investing in companies that are involved in essential industries, such as utilities, food, and healthcare. These industries tend to be less affected by economic downturns and can potentially provide stable returns and dividends even in inflationary times. The chapter also addresses the impact of inflation on bond investments. Graham advises investors to be cautious about the duration of their bond holdings, as longer-term bonds are more susceptible to interest rate changes and inflation risks. He suggests considering shorter-term bonds or bond funds as a way to mitigate these risks. Lastly, Graham discusses the importance of a diversified portfolio in protecting against the impact of inflation. By spreading investments across different asset classes, sectors, and geographies, investors can potentially mitigate the risks associated with inflation and benefit from the performance of various investments under different economic conditions. In summary, Chapter 2 of The Intelligent Investor focuses on the impact of inflation on investment returns. It emphasizes the need for investors to be aware of inflationary risks and adjust their investment strategies accordingly. Graham suggests considering stocks with pricing power, defensive industries, and shorter-term bonds as potential solutions to navigate inflation. Additionally, he underscores the importance of diversification to protect against inflationary pressures and achieve long-term investment goals. Chapter 3: A Century of Stock Market History. Chapter 3 of The Intelligent Investor provides a historical perspective on the performance of the stock market over the past century and extracts valuable lessons for investors. Benjamin Graham begins by highlighting the long-term upward trend of the stock market, despite occasional periods of volatility and downturns. He presents data and analysis from various periods in the past century to illustrate the market's overall growth and the potential for investors to achieve significant returns over time. Graham emphasizes that while the stock market has experienced fluctuations and occasional crashes, it has consistently rewarded patient and disciplined investors in the long run. He cautions against trying to time the market or predict short-term movements, as these endeavors are difficult and often lead to poor investment decisions. The chapter delves into the significance of market cycles, ranging from bull markets characterized by rising prices and optimism to bear markets marked by falling prices and pessimism. Graham explains that understanding and accepting the inevitability of market cycles is crucial for investors to maintain a rational approach and avoid being swayed by short-term market trends. Moreover, Graham discusses the psychological aspect of investing, highlighting the influence of human emotions on market behavior. He emphasizes that investor sentiment can lead to periods of irrational exuberance or excessive pessimism, causing market valuations to deviate from intrinsic values. He advises investors to remain objective, focusing on fundamental analysis and a long-term investment horizon rather than succumbing to herd mentality or emotional decision-making. The chapter also addresses the importance of dividends in long-term investing. Graham emphasizes that dividends provide a tangible return on investment and contribute significantly to overall returns over time. He encourages investors to consider companies with a consistent history of dividend payments and growth, as they often demonstrate financial stability and shareholder-friendly policies. Additionally, Graham highlights the impact of inflation on investment returns and emphasizes the need for investors to consider the effects of rising prices when evaluating long-term investment performance. He recommends that investors focus on real, inflation-adjusted returns rather than nominal returns to assess the true growth of their investments. In summary, Chapter 3 of The Intelligent Investor provides a century-long perspective on the stock market's performance. It underscores the importance of long-term investing, patience, and discipline in achieving favorable investment outcomes. The chapter also emphasizes the significance of market cycles, investor psychology, dividends, and inflation in shaping investment returns. By understanding the historical trends and lessons, investors can gain insights to inform the decision-making and navigate the challenges and opportunities of the stock market. Chapter 4: General Portfolio Policy, The Defensive Investor. Chapter 4 of The Intelligent Investor focuses on the investment strategies and portfolio management principles suitable for defensive investors. Benjamin Graham defines the defensive investor as an individual who prioritizes the preservation of capital and is primarily concerned with minimizing the risk of loss. This type of investor is typically more risk-averse and seeks a stable and consistent investment approach. Graham emphasizes the importance of diversification for defensive investors. He recommends building a portfolio consisting of a broad range of stocks and bonds to spread risk. By holding a diversified portfolio, investors can reduce the impact of individual stock or bond failures on their overall investments. Furthermore, Graham introduces the concept of an investment fund or investment company as a practical option for defensive investors. He suggests investing in low-cost index funds or mutual funds that provide instant diversification and are managed by professionals. These funds allow investors to gain exposure to a wide range of securities without requiring extensive research and analysis. The chapter also emphasizes the importance of asset allocation based on an individual's risk tolerance and investment goals. Graham suggests allocating a portion of the portfolio to stocks and the remaining portion to bonds, with the allocation varying based on the investor's risk appetite. He advises defensive investors to maintain a conservative approach, favoring bonds over stocks to prioritize capital preservation. Moreover, Graham introduces the concept of dollar cost averaging as a disciplined investment strategy for defensive investors. By investing a fixed amount of money at regular intervals, regardless of market conditions, investors can benefit from buying more shares when prices are low and fewer shares when prices are high. This approach helps to mitigate the impact of market volatility and allows investors to accumulate shares over time. Graham also emphasizes the importance of conducting thorough analysis and selecting stocks and bonds with a margin of safety. He advises defensive investors to focus on well-established, financially stable companies with a history of consistent earnings and dividends. In bond investing, he suggests favoring high-quality bonds and government securities that offer greater security and reliability. Lastly, the chapter addresses the role of market fluctuations and investor psychology. Graham advises defensive investors to remain disciplined and not be swayed by short-term market movements or market noise. He encourages them to maintain a long-term perspective and resist the temptation to engage in speculative activities. In summary, Chapter 4 of The Intelligent Investor provides guidance and principles for defensive investors. It emphasizes diversification, asset allocation, dollar cost averaging, and thorough analysis in portfolio construction. The chapter promotes a conservative and disciplined approach to investing, focusing on capital preservation and risk management. By following these principles, defensive investors can build a portfolio that aligns with their risk tolerance and investment objectives. Chapter 5: The Defensive Investor and Common Stocks. Chapter 5 of The Intelligent Investor delves into the specific considerations and strategies that defensive investors should employ when investing in common stocks. Benjamin Graham begins by emphasizing the importance of a defensive approach for investors. Defensive investors are characterized by their risk-averse nature and focus on preserving capital. Graham suggests that defensive investors should allocate a portion of their portfolio to common stocks, as they have the potential for long-term growth and higher returns compared to other investment options. Graham advises defensive investors to prioritize quality and stability when selecting common stocks. He suggests investing in large, well-established companies with a strong financial position and a history of consistent earnings and dividends. By focusing on financially stable companies, investors can reduce the risk of significant losses and benefit from the potential for dividend income. The chapter emphasizes the concept of the margin of safety, which is crucial for defensive investors. Graham defines the margin of safety as the difference between the intrinsic value of a stock and its market price. Defensive investors should seek stocks that are trading at a significant discount to their intrinsic value, offering a buffer against potential declines in the market price. Graham also introduces the concept of diversification within common stock investments. He suggests holding a portfolio of at least 10 to 30 different stocks to reduce the risk associated with individual stock fluctuations. By spreading investments across various industries and companies, investors can mitigate the impact of any single stock's poor performance. Moreover, Graham advises defensive investors to adopt a long-term perspective and avoid engaging in frequent trading or market timing. He highlights the benefits of holding stocks for an extended period, allowing investors to benefit from the compounding effect of dividends and potential capital appreciation over time. The chapter also addresses the significance of dividends for defensive investors. Graham argues that dividends provide a tangible return on investment and offer stability, especially during periods of market volatility. He suggests focusing on companies with a history of consistently increasing dividends and a policy of distributing a significant portion of their earnings to shareholders. Additionally, Graham discusses the role of professional investment advisors for defensive investors. He encourages investors to exercise caution and conduct thorough research before hiring an advisor, emphasizing the importance of aligning investment goals and philosophies with the advisor's approach. In summary, Chapter 5 of The Intelligent Investor provides specific guidelines for defensive investors when investing in common stocks. It emphasizes the importance of quality, stability, and a margin of safety in stock selection. The chapter also highlights the benefits of diversification, a long-term perspective, and a focus on dividend income. By adhering to these principles, defensive investors can construct a common stock portfolio that aligns with their risk tolerance and investment objectives while prioritizing capital preservation. Chapter 6: Portfolio Policy for the Enterprising Investor. Chapter 6 of The Intelligent Investor explores investment strategies and portfolio policies specifically tailored for enterprising investors who are willing to devote time and effort to their investment activities. Benjamin Graham begins by distinguishing the enterprising investor from the defensive investor. Enterprising investors actively seek out investment opportunities and are willing to assume higher risks in pursuit of potentially higher returns. They are more involved in stock selection and market timing compared to the defensive investor. The chapter highlights the importance of a positive approach for enterprising investors, which involves actively seeking attractive investment opportunities. Graham suggests that enterprising investors should analyze individual stocks, identify undervalued securities, and strive to make sound investment decisions based on thorough research and analysis. Graham also emphasizes the concept of diversification for enterprising investors. While defensive investors primarily focus on broad diversification across different asset classes, enterprising investors can diversify within their stock portfolio. By selecting stocks from various industries and companies, enterprising investors can spread their risk and mitigate the impact of individual stock performance on their overall portfolio. The chapter addresses the challenges of market timing and acknowledges that consistently predicting short-term market movements is extremely difficult. Graham advises enterprising investors to be cautious about market timing and instead focus on long-term investment strategies. He suggests that enterprising investors should identify undervalued securities based on their intrinsic value and invest with a long-term perspective. Moreover, Graham stresses the importance of disciplined decision-making for enterprising investors. He cautions against impulsive trading or succumbing to emotional influences in response to short-term market fluctuations. Enterprising investors should adhere to their investment strategies, avoid excessive trading, and exercise patience to allow their investments to grow over time. Additionally, the chapter emphasizes the significance of risk management for enterprising investors. Graham suggests establishing a margin of safety by investing in securities that are trading at a significant discount to their intrinsic value. This approach helps protect against potential losses and allows room for error in investment decisions. Furthermore, Graham discusses the role of investor psychology and the potential pitfalls of being influenced by market sentiment. He advises enterprising investors to be aware of their own biases, avoid following the crowd, and make rational investment decisions based on thorough analysis and objective evaluation. In summary, Chapter 6 of The Intelligent Investor provides insights into portfolio policy for the enterprising investor. It emphasizes the importance of actively seeking attractive investment opportunities, conducting thorough research, and making disciplined investment decisions. The chapter also addresses diversification within the stock portfolio, the challenges of market timing, risk management, and the impact of investor psychology. By following these principles, enterprising investors can potentially achieve favorable investment outcomes. Chapter 7. Portfolio Policy for the Enterprising Investor. Chapter 7 of The Intelligent Investor focuses on providing guidance for enterprising investors in developing their portfolio policies and investment strategies. Benjamin Graham begins by reiterating the importance of a margin of safety in investment decisions. He emphasizes that enterprising investors should only invest in securities that are priced significantly below their intrinsic value. By doing so, they provide a cushion against potential losses and increase their chances of achieving favorable returns. The chapter highlights the concept of diversification for enterprising investors. While defensive investors typically practice broad diversification across various asset classes, Graham suggests that enterprising investors can concentrate their holdings in a smaller number of stocks. However, he advises caution and recommends diversifying across different industries to mitigate the risks associated with individual company performance. Graham also introduces the concept of asset allocation within the enterprising investor's portfolio. He suggests that a portion of the portfolio should be allocated to bonds and fixed income securities, with the remainder allocated to stocks. The allocation between stocks and bonds depends on the investor's risk tolerance and market conditions. Furthermore, the chapter emphasizes the importance of continuous research and monitoring of investments. Enterprising investors are encouraged to stay updated on the financial performance and prospects of the companies they invest in. Regular reviews of the portfolio help identify any necessary adjustments or potential investment opportunities. Graham discusses the role of market fluctuations and investor psychology in the enterprising investor's portfolio policy. He advises against succumbing to market sentiment and making investment decisions based solely on short-term market movements. Instead, enterprising investors should focus on long-term investment principles and remain patient even during periods of market volatility. Moreover, the chapter addresses the potential benefits of adopting a contrarian approach. Graham suggests that enterprising investors can find opportunities by going against the prevailing market trends. By being skeptical and considering opportunities when others are fearful or pessimistic, enterprising investors may uncover undervalued securities. Graham also discusses the role of professional investment advisors for enterprising investors. He advises caution when selecting an advisor, emphasizing the need to choose one who aligns with the investor's philosophy, provides objective advice, and charges reasonable fees. In summary, Chapter 7 of The Intelligent Investor provides guidance on portfolio policy for enterprising investors. It emphasizes the importance of a margin of safety, diversification, continuous research, and patient long-term investing. The chapter also addresses the impact of market fluctuations, investor psychology, and the potential benefits of a contrarian approach. By adhering to these principles, enterprising investors can strive to achieve successful investment outcomes. Chapter 8. The Investor and Market Fluctuations. Chapter 8 of The Intelligent Investor explores the relationship between investors and the inevitable fluctuations of the stock market, emphasizing the importance of maintaining a rational and disciplined approach. Graham begins by discussing the nature of market fluctuations and the emotions they can evoke in investors. He highlights the tendency of investors to be influenced by short-term market movements, leading to irrational decision-making and potentially harmful consequences for their investment portfolios. The chapter emphasizes that market fluctuations are a normal and expected part of investing. Graham argues that investors should view these fluctuations as opportunities rather than threats. He suggests that investors should not be swayed by short-term market movements, but instead focus on the underlying value of the securities they own. Graham introduces the concept of Mr. Market as a metaphor for the stock market. Mr. Market is characterized as an erratic business partner who offers to buy or sell securities at varying prices based on his moods. Graham advises investors to approach Mr. Market with skepticism and not let his emotional swings dictate their investment decisions. The chapter emphasizes the importance of developing a long-term perspective as an investor. Graham encourages investors to focus on the intrinsic value of securities rather than their market prices. By conducting thorough analysis and identifying undervalued securities, investors can make sound investment decisions based on the underlying fundamentals of the companies they invest in. Furthermore, Graham discusses the concept of dollar cost averaging as a strategy for dealing with market fluctuations. He suggests that investors regularly invest a fixed amount of money regardless of market conditions. By consistently buying securities at different price levels, investors can benefit from purchasing more shares when prices are low and fewer shares when prices are high, effectively lowering the average cost per share over time. The chapter also addresses the psychological aspect of investing and the importance of maintaining emotional discipline. Graham cautions against being swayed by market sentiment and urges investors to resist the temptation to speculate or engage in excessive trading. He advises investors to stay focused on their long-term investment goals and not be influenced by short-term market noise. In summary, Chapter 8 of The Intelligent Investor emphasizes the relationship between investors and market fluctuations. It encourages investors to adopt a rational and disciplined approach, focusing on the intrinsic value of securities rather than short-term market movements. The chapter introduces the concept of Mr. Market and emphasizes the importance of maintaining a long-term perspective, employing dollar cost averaging, and exercising emotional discipline. By following these principles, investors can navigate market fluctuations with confidence and increase their chances of achieving successful investment outcomes. Chapter 9. Investing in Investment Funds. Chapter 9 of The Intelligent Investor delves into the topic of investment funds, specifically mutual funds, and provides guidance for investors considering investing in these vehicles. Benjamin Graham begins the chapter by acknowledging the popularity of investment funds, particularly mutual funds, among individual investors. He highlights the convenience and potential benefits of investing in a professionally managed portfolio through a mutual fund. The chapter discusses the advantages of investing in mutual funds, such as diversification across a range of securities and the ability to access professional management expertise. Graham notes that mutual funds can provide individual investors with the opportunity to invest in a wide variety of securities without having to research and select individual stocks and bonds themselves. However, Graham also warns investors about potential pitfalls associated with investing in mutual funds. He emphasizes the importance of thoroughly understanding the investment objectives, strategies, fees, and historical performance of a mutual fund before making an investment. Graham advises investors to focus on mutual funds with a long track record of consistent performance and reasonable expense ratios. Furthermore, Graham cautions against blindly relying on past performance when evaluating mutual funds. He suggests that investors should consider the investment approach and philosophy of the fund's management team and assess whether it aligns with their own investment goals and principles. The chapter also addresses the issue of high fees and expenses associated with some mutual funds. Graham advises investors to carefully scrutinize the fee structure of a mutual fund and consider the potential impact of fees on long-term investment returns. He suggests that lower-cost index funds can be a viable option for investors who prefer a passive investment approach and want to minimize expenses. Graham encourages investors to maintain a diversified portfolio of both individual securities and mutual funds. He suggests that mutual funds can be used as a complementary component of a well-rounded investment strategy, but should not be the sole focus of an investor's portfolio. In summary, Chapter 9 of The Intelligent Investor provides guidance on investing in investment funds, particularly mutual funds. It highlights the advantages and potential pitfalls of investing in these vehicles and emphasizes the importance of thorough research, understanding investment objectives and fees, and aligning investment decisions with one's own goals and principles. By approaching mutual fund investments with a discerning and informed mindset, investors can make more prudent decisions and enhance their overall investment strategies. Chapter 10. The Investor and His Advisors. Chapter 10 of The Intelligent Investor explores the role of investment advisors and the considerations investors should keep in mind when selecting and working with financial professionals. Graham begins by emphasizing the importance of choosing a competent and trustworthy investment advisor. He acknowledges that many investors rely on professional advice due to a lack of time, expertise, or inclination to manage their investments independently. However, Graham also warns investors to be cautious of potential conflicts of interest and the varying quality of advice provided by different advisors. The chapter discusses different types of investment advisors, including brokers, financial planners, and investment counselors. Graham highlights the distinction between advisors who provide transaction-based services, such as brokers, and those who offer ongoing financial planning and investment management services. Graham advises investors to carefully evaluate the credentials, experience, and track record of potential advisors. He emphasizes the importance of conducting due diligence and seeking references or testimonials from other clients. Investors should look for advisors who have a solid reputation, a fiduciary duty to act in the best interests of their clients, and a history of delivering consistent and satisfactory results. Additionally, Graham encourages investors to clearly define their investment objectives and risk tolerance when seeking advice from professionals. By articulating their goals and preferences, investors can better align their expectations with the services provided by advisors. The chapter also discusses the issue of fees and compensation. Graham advises investors to have a clear understanding of how advisors are compensated and whether their interests are aligned with those of the investor. He cautions against excessive fees that can erode investment returns and suggests looking for advisors who charge reasonable fees or provide fee-only services. Furthermore, Graham encourages investors to actively participate in the advisory relationship and remain informed about their investments. He recommends regularly reviewing and assessing the performance of the advisor and the investment portfolio. Investors should ask questions, seek explanations, and ensure they are comfortable with the investment decisions being made on their behalf. In summary, Chapter 10 of The Intelligent Investor focuses on the relationship between investors and their advisors. It emphasizes the importance of selecting competent and trustworthy advisors, conducting due diligence, and aligning investment objectives. The chapter also addresses the issue of fees, the importance of active involvement in the advisory relationship, and the need to remain informed about one's investments. By being diligent and proactive in selecting and working with advisors, investors can enhance their overall investment experience and increase the likelihood of achieving their financial goals.